Appreciate everybody joining us today and being a little bit patient with us. As you can see, the topic of today's conversation is rethinking affordable housing finance. This project, Molly, if you can slide forward, let's see here, let's go one more. We'll skip this, but I do want everybody to, sorry, go back one. Please recognize that we do have some interesting upcoming events. Even though we're getting short on the semester, we do have 2 more faculty seminar series this month. Professor Brodsky will be talking about climate issues in real estate on December 1st, and Professor Savage will be speaking about the economic outlook on December 8th. And of course, I'd be remiss in not getting you guys all excited about the REIT conference on April 7th. Next year. We're also going to be holding a research day that should read April 6th, the day before the conference. We have some topics that we'd like to address, but I'd love to hear from the students and other people in the industry on topics they would like us to cover in greater detail on research day. Molly, if you wouldn't mind, next page. Great. Well, this is kind of an overview of today's topic. Obviously, affordable housing has been on the forefront of everybody's minds since COVID started. But frankly, housing affordability has been an issue for years. And a number of my students joined together in 2019 to think about some interesting and unique ways to pull together different resources to try to address housing affordability. Nantara Goodgame, Whitney Chambers, Cyrus Hoda, Jeff Perillo, Peter Torlak, and of course, Jewel Rogers all started working on this project back in 2019. And what they did is they kind of carved up the slide you see in front of us and explored a little bit more deeply the modular construction space as a means to reduce the cost basis of new development. They also dug into ESG and the social infrastructure investor universe to try to source out, flesh out some I'll call it lower cost capital to come in and provide supportive housing. And then we also explored the REIT structure as a means of raising additional capital outside of traditional corporate donors, if you will, and municipal finance for affordable housing. And so we brought these 3 together in some research that ultimately Molly, Shearer, and Wellern, you who are joining us today and going to walk us through this, kind of finally wrapped a bow on this and got it off my desk. So I appreciate everybody's effort on this to date, and I'm really excited about the outcome. Lastly, before I hand it over to Molly and Wellern to introduce themselves and dig into the report, I would like to frame this conversation in that this and the ensuing report that we'll release through NYU relationships and social media, it's not meant to be the end of the conversation. Frankly, it's meant to be the beginning of a conversation. I think the ideas coming out of this are usable by market rate participants. They should be explored further by policymakers, both at the local, regional, as well as federal level, and by players in the affordable housing space. I think there's a lot to be said by accessing the numerous ESG investors in there, not only for what might be more favorably priced capital, but also synergistic deployment of resources. For example, as I'm sure we'll touch on in a little bit, ESG investors don't only invest in affordable housing. They also invest in health and wellness and other supportive services that I think would be very synergistic to some housing affordable communities. So there's a lot of different avenues to take here, and hopefully this begins a rethink of the status quo rather than being viewed as just kind of an end-all be-all. With that, I'll take a breath. I'll pass the mic over to Molly to introduce herself and Wellern and go from there. Molly, it's all you.
Oh, of course, I'm muted too. So hi, my name is Molly. I'm currently a student at SHAC. I'm finishing up 3 courses this semester, and then I just have our capstone next semester on the finance and investment track for the program. My background is mostly in hotels. I also worked for a fitness startup as well, and now following my passion for real estate, specifically REITs, which you'll hear me nerd out on. So that'll be pretty exciting for you. So That's all the good stuff about me. And Wellern, do you want to go ahead and introduce yourself and then get into ESG?
Yeah, definitely. So as Molly mentioned, my name is Wellern. Nice to meet you, everyone here. I started off more in banking, so corporate side. But after a few years, I actually started my own restaurant and so kind of like pivoted to more of a retail role. And that's kind of where I got interested in real estate as a whole. And then I kind of further went down another rabbit hole of different real estate asset by getting into an industrial. So I worked in brokerage for about a year. And now I work at WeWork underwriting for offices. So I've touched a lot of different platforms in terms of different asset classes and different building types. So I think this project was interesting. The fact that it kind of introduced me and exposed me to another type of assets that I wouldn't have otherwise had the opportunity to touch upon. So yeah, it was great working on this paper, and especially with all the guidance that Molly and I have talked with. Let me share this now. Let's see if I can share. Oh, I can't share the screen. Molly, can you share that?
Yes.
Thanks.
How's that?
Perfect, thank you. So yeah, I mean, just to go into the first topic is what is ESG capital? So ESG stands for environmental, social, and governance. To touch upon these three, environmental is focused on reducing energy consumption and limiting property exposure to hazardous climates. Social is a little different because it's harder to quantify it. It focuses on long-term end user effects. So this could be anything from providing residents with an environment that's very nurturing to raise children in, shorter commutes to work, and having a high labor standards. These are very qualitative items, so it's hard to kind of put a number to it. Governance is something that has to do with moral controversy. This would include acquiring or developing land or buildings through nefarious means such as bribery. This creates a lot of legal burden for both public and private companies. As you imagine, a lot of companies wouldn't want to have any of these stains on their record. It's not really the kind of publicity anyone wants. And investors are increasingly applying these non-financial factors as part of their analysis process to kind of identify material risks and growth opportunities. So over the past few years, ESG capital has been a trending word, really. Some all the way from just taking back a couple of years from 2019 to 2020. ESG funds have captured about more than double in the past 2 years. So about $21 billion all the way to $51.1 billion respectively. So for about 2021, we don't have the whole year captured, of course, but to kind of give an idea so far, the market's set about $54 billion in ESG funding. So it's about 132 impact funds that have started this year. And we kind of look at this chart, it shows what the breakdown of each type is. We have 13% in endowments, 18% in foundations, about 24% in corporate contributions. Public contributions are 42%, so they're clearly the majority, and 3% in other. Kind of going back into corporate contribution, like this little article I read or case study, as you want to call it. So Blackstone actually acquired AIG's affordable housing portfolio for about $5.1 billion back in August. This is kind of like their attempt at their latest affordable housing play. So it's something that they've been working with for a while, but this is kind of like their latest and greatest buy. So as part of their strategy, they were actually going to buy 5,800 apartments in San Diego County from Conrad Prieb's Foundation for about $1 billion. So the goal here is really to keep the rentals affordable, kind of like the whole topic, to residents earning about 80% of the area median income, AMI for short, just something you'll be revisiting throughout this presentation. So the plans were to kind of rehab the housing properties, and according to the global co-head of Blackstone Real Estate, she kind of said in a statement that, and I quote, "These communities provide critical affordable housing and look forward to being long-term owners. We will make significant investments to improve the apartments while also ensuring that they remain affordable and compliant with all rent regulations. We are committed to working with our partners in the sector to expand the supply of affordable housing." So as you can see, like even with huge institutions like Blackstone, they're starting to take a different step in how they want to kind of approach what they're investing. They're looking more to kind of help and better the community around them, as opposed to, you know, hitting the bottom line or just trying to squeeze an extra dollar and make some more profits. This really shows that these private institutions are really trying to make a more conscious effort to help the community. So how does ESG really fit into affordable housing? Well, you know, as I mentioned, that's kind of like what that whole example was, but really as a whole, as an interest in community impact grows, affordable housing is kind of like an obvious option for a lot of these investors. They want lower default rates, obviously, long-term stable cash flows, and just less cap rate compression than other sectors that we're seeing, like industrial or whatever. So ESG insurance investors kind of finds a large array of asset class, such as long-term private debt and equity, real estate equity and mortgages, and preferred stock and asset-backed securities. Other investors, such as banks, kind of have impact investment in platforms that underpin their business operations. And this kind of enables them to focus on specific income groups that can generate more quantifiable metrics to kind of stick to. CDFI investors are financial institutions that work more closely with banks or even other government partners to finance these economic investments. And they really work together to kind of help out local underserved communities or areas that are generally more lower income. So there are independent investment analysts that do track these ESG metrics. And this is kind of a way for investors to really remain accountable, but also being able to determine a reasonable risk-adjusted return. An example would be Sustainability Accounting Standards Board, or SASB for short. They kind of help companies determine what the best ESG practice would be for their industry. So really at the end of the day, a lot of these ESG funds, you know, they've really come a long way from, you know, how much money can we really make at whoever's expense, and not really taking the community in mind. And now they're more focused socially and ethically, which is, you know, overall very healthy for something like affordable housing projects. Now I'm going to switch to Molly, who's going to talk more about the municipal financing.
Cool. So I'm hoping when I switch over, it will allow me to keep up the presentation.
We can hear you just fine and see the presentation, so you should be good to go if you can just change the page.
Okay, that was my issue. It wasn't. Okay, there we go. Cool. And the presentation's all good still.
Yep, you're good.
Yes.
Okay, awesome. Okay, so back to me. Hope everyone's having fun here still. While the availability of ESG funding is fantastic and needed capital, municipal finance is really the foundation for affordable housing or housing affordability efforts. No pun intended on that, it's the foundation, but it is an essential component of creating affordable housing with the addition of private funding and cost saving strategies. Affordable housing regulations are extremely detailed, and I'm going to talk about it from a high level. And don't worry, I'll do a pulse check kind of halfway through. There's a lot of information, but it's super important when analyzing the capital stack for affordable housing. So I'm going to go ahead and talk about low-income housing tax credits, also known as LITEC, other federal subsidies, and then the New York Housing Authority, also known as NYCHA. So the first and most widely used government program is LITEC. The IRS annually allocates a fixed value of tax credits to state and local housing finance authorities, also known as HFA. You'll hear me use that acronym. HFA are the people responsible for doling out the subsidies on each municipality level. So in order to be eligible for LITEC, proposed developments must satisfy one of three affordability metrics. The metrics are based on AMI, which Wellern mentioned earlier. And if you're not familiar with AMI metrics in affordable housing, it's calculated by taking the area median income, say that is $100,000. And then the metric says it's 50%. The affordable housing would have to be for tenants earning 50K or less per year. That's obviously a super high number. I just used it for easy math purposes. So the three affordability metrics, the first is at least 20% of the proposed project's dwelling units must be occupied by affordable households earning no more than 50% AMI. Or number two, which you can follow along with me on the slide on these. There's a lot of words going on. At least 40% of the proposed project's dwelling units must be occupied by and affordable to households earning no more than 60% of AMI. Or at least 40% of the proposed project's dwelling units must be occupied and affordable to households earning on average 60% AMI or less, with no single household earning more than 80% AMI. In all three scenarios, affordable means no more than 30% of a household's income can be allocated toward rent and utility expenses. And then the projects that are prioritized to receive LITEC are the ones that offer the longest duration of affordability and serving the lowest income households. And the ratio for affordable units and the qualifying income metrics must be maintained for no less than 15 years after the property is built, or as whatever is agreed to in the final grant agreement. And then if there's any tax credits not allocated by the HFA after all this process, they're contributed back to the national inventory for other jurisdictions to bid out. Okay, that was a lot to take in, and there's more on how LITEC becomes equity. So low-income housing tax credits were introduced in 1986. They're in Section 42 of the Internal Revenue Code. The actual codes are all available online if you want to get into the nitty-gritty of it, but I'll just kind of do a brief top view of it. So this is how the US calculates tax credits a developer can claim. There's two options, the 9% or the 4%. So first you come up with a development budget, and this should be done with a CPA to figure out the depreciable basis of everything, and then multiply that by either 9% or 4%. So this is especially important to work with the CPA if you're mixing in market rate units as well, because you need to figure out the maximum possible that you can get in tax credits. So the equity raise is equal to the depreciable basis times either the 9% or 4%, times the share of the project that's affordable, times the price you're able to get from investors for these tax credits that you're being given. And then LITEC is administered on a state-by-state basis, even though the federal government is funding it. And the states decide on who receives the tax credits. So in deciding this, when pursuing the 9% project, the funds you raise from selling the tax credits will generate enough proceeds to fund 70% of development costs, and the 4% choice will provide you with 30% of development costs about. And then there's a cap for each state to award the 9% projects. It's a super competitive process for winning the tax credits, and there's also a lot of design restrictions. So like I said, we're just barely scratching the surface here. And then the 4% projects are aren't as much of a competitive process. The projects mostly just need to be financially feasible. So overall, the value isn't really created by cash flow because of the low revenue being generated through the rents. The value is created by the tax credits themselves, and then also the tax deductions you can claim from depreciation and interest payments. So like for just affordable housing on its own without all of these other factors that we're talking about today, one would expect NOI losses to be pretty big, but the tax benefit is the actual value here. There's also value in the PR benefit of doing these transactions. It's hard to kind of translate it into monetary value. But completing these projects definitely help developers and investors with their reputation in communities and states, as well as, with other impact investors. Okay, so another pulse check here. I'm going to go into a few different, you'll see on the slide, there's 3 different other financing opportunities that help with affordable housing. That's Section 8. Section 202 and Section 811. So Section 8, I'm sure a lot of people have heard of before. The Section 8 program allows private landlords to rent apartments at fair market value to qualified low-income tenants. So basically, these tenants can search fair market rentals where they are paying no more than 40% of the AMI, and then the remaining value of the fair market rent is paid directly to the landlord through government subsidies. And there's currently about 90,000 Section 8 voucher holders and about 29,000 owners participating in the program. And then we have Section 202, which offers interest-free capital to nonprofit developers for affordable senior housing. And a cool thing about this is that if the units remain affordable for 40 years or longer, which, as SHAC students know, 40 years is a long time to hold onto a property. But the value in that is that the capital does not need to be repaid. And then the interest-free capital is also coupled with subsidized rents, much like Section 8. And then Section 811 is similar in way to Section 202, but it's for households with 1 or more people with disabilities. All right, so that was a lot of information. Thanks for sticking with me. I have one more really cool thing to tell you about for affordable housing. So in New York, we have New York City, we have the New York City Housing Authority, also known as NYCHA. So NYCHA is considered a public development corporation, and it's controlled by the mayor and a board. So the board is 7 people. And NYCHA is extremely important because 1 out of 14 New Yorkers live in NYCHA housing, which, I mean, that's a huge ratio of New York City residents. It's about 600,000 people. So NYCHA is the largest landlord managing publicly created housing, and they're, like I said, a huge resource, and especially for New York City housing developers, because they can partner with NYCHA on new affordable housing initiatives to buy back NYCHA's current inventory, which I'll get into a little bit. This is done through a regulation called Rental Assistance Demonstration, or RAD, another acronym to add to your list for today. So private developers can rehabilitate public housing buildings, and in return, they get to manage and collect rent from tenants and collect federal rent vouchers as well. NYCHA is trying to convert about 1/3 of its public housing units to private management through RAD by 2028. So they're well on their way to that. They have thousands of units that have been converted already or are switching over now. And some tenants who have gone through the change say it's a vast improvement. I'm sure you can imagine moving into a unit that a developer has recently completed is better than a lot of the affordable units managed by government entities, probably night and day. And then some fun facts about NYCHA that I think are pretty interesting. So like there's so many people that utilize NYCHA for their housing. If it were a city, it would be ranked nationally ranked 34th in population size, which is larger than Miami or Atlanta, just to put things into perspective about how many people NYCHA is housing. And then some facts about the occupants themselves. The average family income is just under 25K per year. And then their rent is about $540 per month. So they're really helping out people here. And then about 42% of these families have additional government assistance like Social Security or pensions and other government program support. So my last little tidbit about them, I'm sure you're also wondering how they're funded, considering how many people their buildings house. So the funding of NYCHA is a joint effort between federal, state, and local officials. The federal government's Department of Housing and Urban Development, also known as HUD, works in partnership with the US Treasury to give housing assistance to each state. So what HUD does is distribute tax exempt bonds called private activity bonds, and then these bonds are allocated to their respective municipalities who distribute them for investment to developers to subsidize the cost of affordable housing projects. So overall, for affordable housing, the strategy is behind the financing portion of it. It's a mouthful and a lot, but it really is the backbone to affordable housing. And these resources continue to be pivotal to the creation of privately owned or operated affordable rental housing. So I'm going to go ahead and hand it back to Wellern to talk about how we can create additional value and cost savings through modular construction.
Thank you. Yeah, that was it's quite a mouthful there.
Yes.
But yeah, switching to something that's a little bit more qualitative. So modular construction. So this is something that's both attractive to ESG investors and is very cost effective, which leads to a lot more opportunities for affordable housing development. So what is modular construction? This is entire units of buildings that are either constructed offsite under controlled conditions. So it's a lot easier to kind of have a lot easier to control. There's a lot more surveillance. And overall, it's a lot safer. The best way to kind of think of it is sort of like Legos, where you kind of build things, or where you're given bricks and you kind of just, or not brick, that's a bad comparison. Well, given like whole units and kind of build it on site. So the units are kind of shipped to the site and assembled there. So there's different segments or different segments in this industry. One of them is prefabrication, which is offsite manufacturing components and then sent to the site. There's pre-assembly, which is assembly of building components into the final position offsite. There's modularization, which is entire building units that are constructed offsite, and it's not just the parts, it's the whole unit. And then they're finally transported to the site and kind of built from there. And then there's multi-trade fabrication, which is multiple trades and contractors that work to assemble components remotely. So if you kind of look at that picture here in this presentation, this kind of shows modularization, which is, as you can see, it looks like just basically a single crane and maybe a couple people just kind of making sure that the site's cleared and where to kind of place these modular buildings. It really looks like a shipyard, if anything, with those box containers. Essentially, that's very similar to what it is. And as you can see, like it's a fairly clean site from the picture, and it just looks like they're just kind of stacking them on top of each other, kind of like blocks. So this kind of poses the question, why modular now? And the reason why is because it honestly just solves a lot of pain points that current developers have and current people working construction have. Obviously, there's a lot of other benefits to it, especially with affordable housing, but just from a fundamental perspective, there's a lot of benefits. One of the huge issues in traditional construction that we face today is that's the shortage of skilled laborers on the actual job site. So with this, because you don't need as many people at the site, it kind of scales it in a way so that you don't need as many laborers at the site as well. With today, with how fast we're kind of urbanizing everywhere, there's an increased pressure on project schedules and as well as costs. So this kind of diminishes both of those ends. You have fewer costs as well as a quicker time to delivery. With improved technology, this kind of makes sense. You know, we have 3D housing nowadays. You can literally print a house, which is insane. But this kind of shows us like real estate is one of those lagging industries when it comes to innovation. And I feel like it's really been the past decade where things are starting to pick up and people are finding different ways to build and different resources. And one of the more important things is really a safety concern, right? Because with fewer parts kind of laying around, with fewer workers in general, there's a lot less traffic. There's a lot less congestion on the site, as well as around the site. So while many developers are starting to shift more into this mode, we still have a lot of developers and people in construction that kind of still stick with the traditional method, which is fair because this is still a pretty unknown concept, or it's a fairly new concept, and there's still a lot of unknown parts to it. So it makes sense why a lot of developers may be kind of hesitant to switch right away. So talking about the different benefits of modular construction, there's a few, but just to name a couple here, it's much greener. You know, there's a reduced energy bill of up to 25%. Usually on the construction site, there's a lot of a waste of disassembly and a reassembly of everything. So you don't get as much of that. There's faster construction. Like I mentioned, projects get finished 30 to 50% faster. And the main reason why is because the site preparation and the actual completion of the module are kind of done simultaneously. So while you're kind of doing maybe your due diligence or just getting the site prepped normally for any kind of building or assembly, you can already get most of the building done on an offsite. And safer construction, again, with safety concerns, this is pretty big. Off-site manufacturing kind of reduces any type of on-site accidents. One thing to kind of think about is that there's fewer vehicular traffic, and the reason is because, you know, a lot of times there's a lot of traffic on the road, or there's a lot of people walking by, and you know those are also going to cause a lot of constraints and accidents as well. So now that you don't need as many people, you don't have as much like spillage of the site, more or less. It's easier to kind of control and just overall more surveillance. And labor efficiency, controlled environment with skilled workers all in one place. They're able to work across multiple trades, adding to the solution of avoiding these labor shortages that we currently have. And these kind of all go into this market penetration factor of why this is so attractive. And a lot of these will be very similar to what I mentioned, but just kind of like dug deeper into the reasoning and the market penetrations. So labor construction costs, this involves fewer subcontractors and increasing profit margins. Well, obviously, like the main goal of ESG isn't to, you know, make as much money as possible, isn't to really, you know, create the greatest amount of wealth, because in itself, it's not really, it's really not going to do that. And the purpose really isn't for that. But, you know, while it's also good for the environment, it's also really beneficial, the fact that it can also increase your profit margins. Supply chain and logistics reduces size constraints related to modular transportation and local site constraints. There's a more predictable site, which in turn creates a more controlled environment. Like I said, because the site that you're building on and the site that you're working with is not going to really be spilling over to the streets or to other people's properties. It's a lot easier to handle, and you don't have as many problems with that, at least. And quality perception, which optimizes time, energy, and resources. So, and the last one is really regulation. So early adopters will provide kind of a roadmap for these high standards. Because it's so new in terms of regulation, we don't really know what that is going to fully entail as of right now. But as modular construction becomes more mainstream and even mandated for affordable housing projects, there could be an incentive here for developers to kind of hop onto this trend a little bit early on. And this way they can kind of set the standards and kind of like be the first ones to kind of get into this field and really popularize it. So with that said, I'm going to switch over to Molly, who's going to give us a little breakdown of REITs.
Cool. So let me just get this situated, if I can. Oh gosh. Okay, how does that look?
Perfect.
Okay, great. So
Did you want to grab this one, Molly? Or do you want me to do it?
what?
Were you prepared to grab this screen?
Yeah.
Cool.
This is where I nerd out. What do you mean? So I'm going to talk about the usage of REITs in all of this. REITs, which for those of you that aren't familiar, are real estate investment trusts, and they're an investment vehicle that's essentially high level run as a corporation. But if all regulations to act as a REIT are met, corporate taxes on taxable income are not paid. So it adds to the cash flow for affordable housing. And I'll give you a little bit of background on REITs for those that aren't familiar. Like I told Professor Robinson, I tend to nerd out on this. So I hope this is exciting for you as it is for me, but also simple to understand. So to be considered as a REIT, you have to adhere to quite a few regulations. A full list can be found on the SEC website, but the few that really stand out to me the most are that you must be an entity that would be taxable as a corporation, if not for the REIT status, like I said, be managed by a board of directors or trustees, have shares that are fully transferable, have a minimum of 100 shareholders, have no more than 50% of shares held by 5 or fewer individuals, and then also derive at least 75% of gross income from real estate related sources. So it's super important if these rules aren't abided by, you're being taxed as a corporation, which no bueno. So why use a REIT in this situation? Like I said, using a REIT allows for additional use of capital because the corporate taxes aren't paid so long as 90% of the taxable income is distributed to shareholders as dividends, aka savings on taxes. So REITs have historically provided investors dividend-based income, competitive market performance, transparency to investors, liquidity, inflation protection, especially important this year, and also portfolio diversification. So investors love all of these factors. And one of the huge factors in using a REIT as an investment vehicle is that investors are familiar with REITs. So it makes it a lot easier to capture things like ESG funding. The advantage for everyone in the affordable housing space that use the REIT structure is that it's a label that these investors understand. And when you're asking people to invest in something that's not their normal type of investment, they'll shy away. But if you offer it in form of, say, a REIT, they find some familiarity. So overall, the REIT structure adds a really great level of tax efficiency. More NOI is generated out of properties that flow up because the REIT structure is not paying entity level taxes. So as you can see on the screen, we're going to talk about 2 affordable housing REITs that currently exist. And I'll do a little bit of background on types of REITs super quickly. So there's 3 types of REIT models. There's the equity model, the mortgage model, and then the hybrid model. The equity model are REITs that own or manage income producing properties. Most REITs are equity REITs. And then there's also the mortgage model, which are REITs that invest in mortgages, mortgage-backed securities, and related assets and generate revenue through interest income. So not actual properties. And then there's the hybrid model that puts both of these types models into one. So I'm going to talk a little bit about the Housing Partnership Equity Trust, also known as HPET, and then the Community Development Trust, CDT. Both of these REITs are privately held. If they were public, it would provide greater access to capital, but that would also mean that they're exposed to the volatility of the open market and expose developers directly to the demands of shareholders. So being a private REIT, they're more able to set expectations for capital, funding, etc. It's really hard to compare and contrast affordable housing REITs since there's not a lot of them. So I'm going to tell you a little bit about HPET and then a little bit about CDT. So Housing Partnership Equity Trust, they use the equity REIT model. They serve about 3,000 households in 7 different states, and they have 14 properties in their portfolio. HPET works with nonprofit partners to create affordable rental housing in changing and up and coming neighborhoods where residents have access to the central business district, and it allows them to be close to retail, education, doctors, and very importantly, public transportation. So HPET is very tied to not only making housing affordable, but also making sure their residents have the resources to live a comfortable life in general. And you can find a lot more information about HPET on their website. There's a ton of stuff about all of their ESG efforts. And then I'll also go into Community Development Trust, CDT. They were founded about 22 years ago. So this REIT's been around for a while. They use the hybrid model. So they have both equity and mortgage in their portfolio. They serve just over 8,200 households in 16 different states. They have 18 debt commitments and they have 7 equity investments. They're also involved in charter schools, a little bit different than how HPET has kind of set themselves up. And then about half of the properties that they have are very close to public transit, although they do hold 2 rural properties. CDT also has community facilities on site at the majority of their properties. So not only are these REITs creating affordable housing, but they're doing it with an actual purpose, which is really nice to see. So in all, using a REIT as an investment vehicle optimizes the ability to raise funding and provides a real padding of capital due to the taxation benefits. And then to sum up all this information about using REITs for affordable housing, I really like the quote on the slide from Ann McCullough, who's the CEO of HPET. And so it tells about the benefits to the investor side the best. She said, if you have a diversified portfolio, an affordable housing REIT makes a very nice middle piece. You're making more money than you would make on treasuries. You're impacting the community and you're not going to lose your shirt. So in saying that you're not going to lose your shirt, she's referring to having a little bit of security, knowing that affordable housing is at least partially government backed. You're making a bit more than treasuries, but you still have that security. And then, by the way, Ann McCullough is awesome. If you get the chance to hear her speak, she spoke at one of these events either last spring or last fall. And then she also spoke at the Capital Markets Conference last spring. So yeah, go listen to her if you can. 10 out of 10 recommend. And then I'll just bring it all together, everything we've talked about. Let me see, I think I have another slide to share as well. There we go. Okay. So bringing everything together, ESG, municipal capital opportunities, modular construction, and the REIT status. If you take a look at everything, you'll see that both government and market-based approaches are needed to address affordable housing and the crisis that we're currently in with it. The cost of capital can be reduced tremendously by using REIT status. ESG funding year over year shows that investors now more than ever are dedicated to helping the greater good. Like if you visit any publicly traded company's website and take a look at their shareholders reports and presentations, there's more likely than not a huge ESG section in it. It's become an expectation of shareholders. And then as Wellern talked about modular, it allows about 30% cost savings, 50% faster speed to market, and improved labor efficiency and safety. And then the government subsidies, like I talked about, really lay the groundwork for all of this to be possible. And then this nice quote from Professor Robinson, I think it's from him. There are no silver bullets to making housing affordable, but a creative collective approach can activate multiple solutions to create change. So that brings it all together right there for you. And then not to keep talking your ear off, but I do have some recent news for those that are interested in the affordable housing in New York in particular, that's happened in the past week. So the governor of New York announced this week that $5 million in funding will go toward affordable housing buildings to upgrade energy efficiency to cut carbon emissions. As finance students, we know not only is this good for the environment, but energy efficiency cuts costs in the long term. So yay. And then another thing that happened is a new building in Brownsville in Brooklyn just opened with 100% of the units affordable. It's 179 units. And it was developed by NYCHA along with private entities. So the land that was previously vacant is leased by NYCHA to the private entities and they built it and they'll run it, etc. And then one last piece of news, I think this happened, or this was announced yesterday. I think it was like 12 hours ago. I don't know. Mayor-elect Eric Adams said that we should zero in on NYCHA, that it's been long overdue and it needs to be fixed in a real way. So fingers crossed for more positive news in the affordable housing sector. And that's all I have for you. I don't know if Professor Robinson, do you?
Yeah, fantastic job, Molly. Amazing job, Wellern. I've really been blessed to be able to work with you guys, as well as Antar, Whitney, Cyrus, Jeff, Peter, and Jewel on this project. And I think the fact that I've been supported by such a wide range of our finance and development students demonstrates what we really need to do to address housing affordability. And it's the unnamed quote at the bottom of this page. We really need to think differently. There is no one magical solution to solving it. There's zoning issues, there's labor issues, there's cost input issues, cost of capital issues, transparency issues, you name it. And I think being able to tap into new markets, Nico, as I put into the chat box, is one that's looking to tap into, everyday retail investors who want to affect change. I definitely encourage each of you to share these reports, share your thoughts with all of us. And help to continue to drive this forward while you're here at SHAC, but also more importantly, as you leave. Let's keep the conversation going and see if we can start pushing some of these unique aspects to bring down the cost of housing affordability. Maybe with that, were there any questions that came up that we could address? Molly or Wellern, I don't think I have visibility into the Q&A box, but
I do. If anyone has questions, feel free to do the hand raise, or I don't know if everyone has access to send a message, but
cool.
Either one.
Flip one more page. Feel free to contact Me directly, I have far too many ways to be contacted. But definitely send me any questions, comments you might have. And then Molly and Wellern also have their contact information in here as well, I believe.
Here's mine. Can add me on LinkedIn, email me, whatever you want.
And Wellern's, there you
And
go.
Wellern is here.
There you go. Well, fantastic job. I really appreciate the work Molly and Wellern you did. It feels good to get everybody else's work finally done and wrapped up and have this conversation and get it going. So thank you everybody for joining us. And that's it. Have a great rest of your week.